Greetings, friends. This is Oleh Ivchenko, head of the company Pareto. You're watching another episode of Pareto Point, our weekly review of the most interesting tax events from the world of transfer pricing, CFCs, and international taxation. Today, we'll talk about the new powers granted to tax authorities regarding controlled foreign companies, and we'll take a look at the United States, where Meta is disputing with the tax office in the biggest IT case of the year, and loan guarantees have become the reason for additional tax assessments. Now, let's dive into all of this in more detail. Let's get started. As of October 3rd, 2025, a new order from the Ministry of Finance of Ukraine, dated August 29th and numbered 446, has come into force. This order establishes a new procedure for exchanging tax information with the competent authorities of foreign countries. Now, the tax service can receive information about controlled foreign companies, even without an official request. This is called spontaneous information exchange. If the tax authorities have suspicions about tax evasion schemes or the use of shell companies, an investigation can begin much more quickly. Court practice shows that for late submission of CFC, controlled foreign company reports, businesses are already receiving significant fines. Therefore, owners of such companies should ensure complete reporting, high-quality transfer pricing documentation, and confirmation of beneficiaries. Because the new rules are a signal that the era of offshore tranquility is irreversibly coming to an end, and tax control is becoming increasingly global. In the United States, Meta, the company that owns Facebook, Instagram, and WhatsApp, and the U.S. Internal Revenue Service, IRS, have once again clashed in court over transfer pricing. The tax authority believes that Meta understated its tax base when it transferred the rights to its code and trademarks to its Irish subsidiary. The IRS insists that the intellectual assets were undervalued, which resulted in profits ending up outside the United States. Meta, on the other hand, responds that it used the profit split method within the framework of shared use of intangible assets, as recommended by the Organization for Economic Cooperation and Development, and acted in accordance with the arm's length principle. During the court hearings, it must be determined which valuation model should be considered justified, the one proposed by the company or the calculation of the tax authorities. The outcome will determine the fate of the billion-dollar additional assessment, as well as the approach to valuing intangible assets in transfer pricing worldwide. 7 years ago, in October 2018, the U.S. Tax Court considered the case of SIH Partners versus the Internal Revenue Service. The tax authorities decided that two controlled foreign corporations should recognize income in the U.S. because they acted as guarantors for loans. In other words, even if no money actually changed hands, the mere fact of providing a guarantee was considered an investment in U.S. property and therefore a repatriation of profits. The applicant company objected. They argued that such rules are unfair because they do not take into account the actual circumstances of the deal. However, the court sided with the tax authorities. It confirmed that since the 1960s, the U.S. has had rules under which the income of controlled foreign corporations can be taxed, even if the money has not actually entered the country. This case serves as a reminder, in the field of international taxation, there are no trivial details. I, Oleh Ivchenko, and the Pareto team thank you for being with us. If you found this episode useful, please support it with a like, a comment, and a subscription. Do you have questions or topics you'd like to discuss? Write in the comments below the video and we'll be sure to respond. See you in the next episode of Pareto Point.